Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We're bringing the VRIC to you each and every week with our series of expert online panels. There's not many that I've been as excited for as the one that we're presenting to you today. We've got Leigh Goehring and Adam Rozencwajg from Goehring and Rozencwajg, an investment firm dedicated to researching and investing in the natural resource industry. If you are interested in the commodity space and you are not reading their research, I highly recommend it. It's available for free on their website, free of hyperbole, just in-depth research. And it's an honor to have you both on the show today. We're going to be talking about gold, uranium, the energy sector, and a whole lot more. Gentlemen, thank you so much for being here today.
Jesse, thank you for having us.
Yeah, great to be here.
It's a pleasure. Now, I want to start with the opening of your latest market commentary, where you wrote, over the past 125 years, commodities have reached points of extreme undervaluation relative to equities on four notable occasions: 1929, 69, 99, and most recently 2020. After each of the first three lows, commodities and natural resource equities went on to dramatically outperform the broader market, and we suspect history is poised to repeat itself. So firstly, what were the main drivers for commodities outperforming equities in those time frames, and what makes you confident that history is poised to repeat itself today? Leigh, I'll start with you on this one.
Okay, Jesse. What's interesting about today's period is that the background that has produced each one of those previous periods, like you said, the late 20s, the late 60s, the late 1990s, and today, the background for each one of those situations is almost exactly the background of today. And so what am I talking about? The first is that previous to each one of those commodity low points, there was a bear market in commodity prices that lasted almost a decade in previous to that, in which commodity prices on average in each one of those bear markets declined somewhere between 60 to 90%. Also, was interesting that was present in each one of those periods is that each one of those bear market lows in commodity prices were preceded with a extended period of excess monetary creation. Now, you can argue why that happened. I would say that it probably happened because of declining commodity prices and declining inflationary pressures. The central banks during those time periods were able to run very, very loose monetary policies. The third characteristic that occurs in all three periods is that each period, possibly because of excess monetary creation, experienced periods of intense financial speculation. Obviously the 1920s had a huge bull market in stocks that, peaked in the third quarter of 1929. The late 60s had multiple market frenzies. There was the gunslinger mutual fund craze. There was the conglomerate craze, and then finally there was the mother all crazes. There was the Nifty 50, which carried on all the way into the first quarter of 1973. The late 1990s. That was the dot-com bubble. We were all that's was it. That's now we're in our institutional memory, and we can all remember that. And today, obviously, we have got going on. First we had the FANG craze, and that is now metamorphosed into the Magnificent Seven. So the thing is that which I would say that this is probably the mother of all crazes, given the valuation extremes that we reached. But so each one of those periods had those three background characteristics, and finally the fourth characteristic, which has not happened in this period, each one of those periods was characterized with a significant monetary regime change. And that has a huge impact on commodities. Obviously, in 1930, Britain left the gold standard, which obviously resulted in Roosevelt devaluing the dollar against gold by 60% in 1933. The late 1960s, Johnson started the monetary regime change process in 1968 when he removed the 25% gold backing of every dollar in circulation. The U.S. was running out of gold. It was all flowing to Europe. Nixon then instituted the mother of all monetary regime changes in 1971 by abolishing the Bretton Woods gold exchange standard. The late 1990s had the Asian currency crisis, which resulted in all the Asian currencies being pegged at radically undervalued rates, which swung the trade deficits in Asia into massive trade surpluses, which was massively positive to commodity prices. And today, we don't know what the monetary regime change is. There's a lot of talk of what it might be, but there's a lot of attempts going on to change it, including basically the bad guys in the world trying to undermine the U.S. dollar reserve currency status. So I'm convinced, both Adam and I are convinced that there's going to be a monetary regime change. It's what form it takes, we don't know, but it's going to wind up being massively positive for both gold and commodities in general, just like it was in 29, just like it was in the late 60s, just like it was in the late 1990s.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
Great summary there. And Adam, I'd love to hear your thoughts as well, and maybe some commentary on what Leigh was saying about this potentially being the mother of all crazes when it comes to the broad market, this AI craze, FANG stock turned into the Magnificent Seven. Are market participants just not looking back on history when we look at the extreme overvaluations at the moment? Why does history keep repeating itself in that sense?
Oh my goodness, no. Investors definitely don't look back into history. I don't think investors look forward more than 6 months, and I don't think they look back probably much more than 6 months either. So certainly no one's looking back to the big cycles of the 1960s and 70s or the 20s and 30s, or even, as Leigh mentioned, those that are in our institutional memory, like the dot-com bubble. And we have to remind ourselves of that sometimes when we were writing, like our title of our essay was going to be, could this be 1956 all over again? Meaning the first time that commodities became cheap in that cycle, but still had years to go before they bottomed relative to stocks. And we were writing about the cost of being early. And I think even we had to realize that people might not remember what 1956 held for commodity markets. So no, I don't think there's any institutional memory that tries to look back on how things are undervalued. And by all measures, things are as extreme, at least in our little corner of the world, as they've ever been. If you take a look at commodity prices relative to financial assets, 2020 was the absolute low in our data set going back 150 years. And if you look at weighting of energy stocks and material stocks in the S&P, which is maybe a blunt instrument, but gets a pretty good handle as to whether these things have a lot of capital flow coming in or coming out. It got down, the long-term average for energy in the S&P is about 14%. Big market tops happen between 20 and 30%. We got to 1.9%, 90% below the long-term average, and 99% below the high. And so things are certainly as extreme as they've ever been. Now, prices have recovered a little bit since then. Natural resource stocks, energy stocks in particular, have led the market, believe it or not, in the period following the bottom in March of 2020. They're giving back some of that relative gain relative to tech now, clearly. However, they're still the best performing sectors coming off the bottom in March of 2020, but you're still below 4% weighting in these indices. So are you as cheap as you were when oil traded negative in 2020? No, but on the 130 years that we look at data, absent 2020, you're still as cheap as you've ever been. You have not even made the old lows in past cycles. And one thing that I'd like to just touch on that Leigh was alluding to in these big cycles, they really serve as a good proxy for the capital cycle in the resources business. Because when investors become super bearish, when commodity prices themselves fall, equity valuations fall even more oftentimes, and capital just flows out of the space. And that has the impact on all the price charts that we're talking about. But what does it do to the industry? Well, it means that they become so starved of capital that they're unable to invest in new projects. And depletion begins to eventually take hold. And that starts to ratchet this market tighter and tighter and tighter. And you can go 1 year, you can go 2 years, and you'll be maybe still in a slight surplus following what had been a decade prior of really, really high capital spending in the industry. But eventually you slip that market from slight surplus into slight deficit. And because commodities are all priced on their marginal units, you start to see massive price increases, and eventually money starts to flow back into the space. That's the classic model. That's the classic commodity cycle. It repeats itself over and over again. The cyclicality, I think, in commodity prices and natural resource stocks is really a reflection of that capital cycle. Money flows out, no one invests in projects, you tighten the market, things slip into a deficit. Everyone extrapolates the trends, they extrapolate these periods of plenty out into the future, and they neglect to see that depletion is actually switching from surplus into deficit, and then prices ratchet much higher, and the companies that control high quality assets earn supernormal profits for what can be longer than anyone expects, because it takes so long to bring on new projects, bring on new development. Certainly, if you haven't been exploring for what your next round of new projects is going to be. So that's where we are now. We're starting to see it, the cracks in the foundation, I think, on supply across the board. We certainly see it in the uranium space, where projects are being pushed out and not making their targets. You see it definitely now in U.S. natural gas. And those are two areas that, unsurprisingly, probably to the listeners and viewers, are two areas of most excitement in the market today. But really, you see it in a lot of different commodity markets, certainly in gold and certainly in copper as well.
Well, we're going to talk about uranium and natural gas a little bit later. First, I want to talk about gold stocks here, because you also noted in your recent report that gold stocks have never been cheaper. Does this include the major producers like Agnico Eagle, Barrick, Newmont? Is it the developers or explorers you're referring to? Or are you seeing this across the whole sector? And if you could break that down for us. And Leigh, I'll go to you on this one.
Yeah, I think that study that we did, it was centered around producing companies that we could get financial reports going all the way back to the late 1990s, which ironically, we're talking only about 10 companies now that have a continuous history going back that far. So that valuation, massive valuation discount, and the fact that they are cheaper than they've ever been, that term that we gave was to those stocks. So they were the big producing stocks. However, I would say that given my observation regarding the entire gold space, I would say that my observation, looking the smaller and more speculative the company gets, the cheaper it gets relative to where they've ever been before. So the thing is that gold stocks, on average, the big producers, are as cheap as they've ever been based upon our methodology. And Adam can talk about that methodology, because we looked at it a couple different ways. But our other observation is that, yes, the big high quality producing companies are cheap, but if you're willing to go down to companies that have good projects that aren't in production yet, or even better, some exploration companies that have good exploration projects going on, that those are the cheapest out there. And my observation, and we can't empirically do this because many of these companies weren't around back then, is that they're as cheap as they've ever been as well.
And Adam, could you speak to the methodology that you used to come to this conclusion, and any thoughts you'd like to add to what Leigh said as well?
Yeah, no, as far as the methodology goes, we like to look at things at a price to net asset value. So we like to do a discounted cash flow model on all the company's reserves and compare that, debt adjusted per share, and compare that to the stock price. It's a simple analysis. I think it is the most robust analysis. Ultimately, the value of these companies will come from their ability to generate cash, and that's what, as a private owner, I would certainly want to pay for. There's only one problem with that methodology, and what's interesting is that it's when we try to look at price targets and set price targets. What we like to do is use the long-term commodity price that we envision, the long-term equilibrium price. And at major market bottoms, our view of the long-term equilibrium price better be quite a bit above the spot price. Otherwise, we wouldn't want to be involved in it. However, when you go back and you try to look how cheap commodities stocks are now versus in the past, what you really need to look at is what the market is pricing in relative to the spot price of gold, let's say, right? So you have gold today, $2,500. What's the discounted cash flow on today's price? Not on what we think the price was, and not what we thought the price was back in 1999 or in 2005 or 15 or what have you. So the problem with that methodology then is if you go to periods of major gold bottoms, which is when, of course, you want to be getting very excited about owning gold stocks, right when the market bottoms and gold price is about to move a lot higher. The companies oftentimes will look awfully expensive because they'll be generating little to no cash flows at all at those prices. When gold bottomed at $275 an ounce in 1999, the industry's cash cost was in the 300s. And so if you ran a discounted cash flow analysis, you would say, oh, better short all these companies. They're all effectively worthless. And of course, that would have been exactly the wrong decision. So at major market, I would say in the middle part of a gold move, when gold companies have a good margin, I think that analysis is entirely appropriate, but it starts to get a little bit squirrely when gold prices reach their extreme low valuations, particularly relative to the cash costs. So we turn to a different methodology, which we think is incredibly illustrative and helpful, and also shows that today gold stocks are as cheap as they've ever been. And that's to try to consider a gold company as a string of call options. And I don't want to get, bogged down in too much terminology, but basically, a company can be thought of as this basket of stock options where each year the number of stock options against the gold price that you have is equivalent to how much the company will produce in that year. The strike price is the cash cost to produce. And then the spot price is the underlying price is the gold price. And so basically, just like a call option, if the gold price is above the strike price, aka the cash cost to produce, you'll earn the difference between that, times however many ounces you're going to produce that year. And what I think that really does well is it captures the intuition of why investors would still want to own gold stocks at the bottom, and why, frankly, many do own gold stocks even at the bottom. And that's because they want to have an optionality. They want to have exposure to a potential rising gold price. And there are two options in theory, although few people think of it this way. But their options would be to go out and buy a gold company or buy a basket of call options many years in the future that would have a similar payoff. And if you can model what the value of those call options with a similar payoff would be, then, in theory, that's the value of your company that would give you those same exposures. And so we call that the real option value that's embedded in these gold companies. When gold is well above the cash cost, like it is today, that number converges with the discounted cash flow because the option value in that option goes way, way down as it goes in the money, and it becomes just a straight, exposure to that to the gold price. When, however, it's at or near the cash cost of production, at or near the strike price of the option, then it starts to take on different parameters, and it shows that there's more value at the absolute bottoms when gold gets really depressed than a straight DCF would show. And so that allows us to go and compare how bearish investors seem to be today compared to how bearish they were at the very bottom in 1999 or again in 2015, which was another major low for gold and gold stocks. And what we see in both those cases, certainly on a DCF and also on a real option value, is that gold stocks today are as cheaper than they were in 1999, believe it or not, and as cheap as they were in 2015. And that's really saying something, because those were really, really, really big deviations from the long-term averages. Those were really, really low points. And most importantly, those were really good times to get involved in gold equities. And we don't think that this time will be different either. However, this time, that's your return potential, which I think is really good. Your risk potential, though, is a little bit different here, because in 1999 and in 2015, you had gold that had pulled back, in 99, it had pulled back 75% over 20 years. And in 2015, it had pulled back by 50% over 4 years. And so, you really kind of had to take, I think, quite a bullish view and quite a differentiated view, particularly in 1999, to say, okay, look, it's been a bear market for 2 decades, basically everyone's institutional memory. It's been a decimating bull market that's seen the gold price fall by nearly 80%. And I'm going to go out and buy gold stocks. Now, mind you, I should point out that Leigh did just that. He was featured in a Forbes magazine article in 1999 that said, buy gold, it'll be the best performing asset class of the decade, with a $2,500 price target on it. So really ahead of the time. But also, in 2015, you had to be, I think, quite entrepreneurial, quite risk-taking to step in front of that bear market and say, this will turn. And I think the fortunes of these companies are about to get better. Today, though, gold is in quite a bull market and margins are really, really high. So that turn has already been put in here. And gold now is trading, quite well. It has buying from the central banks. It has buying also starting now from the Western investors and speculators. So I think the return potential is exactly the same as it was in the past. Gold stocks are as cheap now as they've ever been on our metrics. But the risk side, I think objectively is a little bit less here, if not a lot less, because you're already in an environment where gold's performing well.
Great. Well, I want to switch over to uranium here. You pointed to a myriad of reasons why you're still bullish on uranium. The report was published before Kazatomprom announced revised production guidance, indicating they would produce less uranium than anticipated. How much of an impact do you think that will have? And we did see the equities briefly respond to that news, I believe, for a total of maybe one trading day. It could have been two. We saw kind of a knee-jerk reaction from the market before they then started ticking down lower once again. What are your thoughts there? Leigh, I'll go to you.
I think the announcement that Kazatomprom made, I think it was August 23rd, had incredible long-term impacts to the market, which, as of today, I don't think people are appreciating. Obviously, Kazatomprom had promised about, I think it was like 17 million pounds of production increase in 2025 versus their raised 2024 guidance. And as you mentioned, Jesse, we did, I was back, I was in Almaty back in early part of April of this year. I met with Kazatomprom and I was able to pry out some information from them about what was happening to that 2025 production estimate. And of course, we did 2 days before it came out, we did a big blog where we mentioned that this disappointment was definitely coming, which of course it did in the next 2 days. What it is that even if Kazatomprom had been able to produce that 78 or 79 million pounds of uranium in 2025, the deficit in the uranium market was still big and still structural. There was nothing that was going to change it. And the fact that you've lost, 12 million pounds off of that original estimate means that the structural deficit that was in everyone's models for 2025 and on is only going to get worse. Now, so the production disappointments from Kazatomprom are a very, very big positive. And what's interesting too is they didn't make any pronouncement of what their 2026 production numbers might be, which again indicate that Budono, I can have trouble pronouncing Budonovyeski, number 6 and number 7 mines are going to be very problematic going into 2026, just as they've been problematic in 2024 and 2025, which means that we may not see much in the way of production increases from Kazatomprom in 2026 either. So very, very positive. I think the reason why it was only a one-day event is that if you look at the ownership of the uranium names over the last 6 months, it's definitely become a very hot money hedge fund centric, gathering there. They're obviously all in their pods. They're chattering back and forth how much they love this, love that. And of course, what happened in the last 2 or 3 months is I suspect a lot of those pod traders that all had those uranium long positions are no longer pod traders. And I think that the thing is that they've had a lot of liquidation. I think that's the source of it. It was the fast money, the pod trading community, which has now been partially decimated, partially closed down, and the idea that there's no one in a short-term basis to buy the stocks. That's going to change. The fundamentals are going to win out. Um, this uranium bull market, like I said, it in 2007 we hit almost $140 a pound. In this cycle, we've only hit about 106. The there's the structural tightness in this market is infinitely greater than it was back in the mid 2000s. So this bull market still has one huge leg left to run. There, as far as the supply, the biggest risk of supply, the increased supply was going to be Kazatomprom. That is not coming going forward. And I think you're giving another buying opportunity here. Like for example, if you look at this Australian uranium stocks, they pulled back, 50, 60%, all of them in the last, couple months. And as a uranium buyer, you are being given another buying opportunity.
And Adam, your thoughts as well. And I'm wondering, in terms of market participation in the uranium space, how much of it is the overly emotional retail crowd, the ones posting the memes on X and being extremely despondent when the price goes down and extraordinarily jubilant when we see even a small rise? Is that affecting the market, the retail participation? How do you see that versus institutions at the moment? And do you expect more institutional investment in the space coming up ahead?
Well, it's an interesting question, and I can't really speak to the retail crowd. I don't, obviously I see their tweets and things like that, but I don't follow exactly how much capital from them is coming in. I do think that what Leigh was pointing to is dead right. Over the last 12 months, we saw, I think the big driver of capital was the institutional money that started to come in, and the really fast institutional money. So this was not, big allocations being made by long-term sticky investors. This was really hedge funds, and we saw a huge amount of interest from the hedge fund community. And having worked at a hedge fund for a long time, I do know how some of these guys operate. Not everybody, but a lot of people, are either in it for the momentum, or they're just simply, suffer from pressures from capital allocators within their firm, like Leigh was alluding to. Their pods get allocated more money or less money based on their performance. So while it's working, it's a virtuous cycle, and then it can undo awfully quickly. And I think that we saw that all coming earlier this year. We debated how to handle it, but ultimately the bullish underlying fundamentals were so strong that we didn't want to be caught, out of this market, because we do see this huge tightness, and the tightness is there. I think that's a big difference in other commodity markets. You typically have to look out into the future and project supply and demand trends as far as how they're going to slip from a surplus into a deficit. In the case of uranium, however, the uranium markets are and have been in a very large structural deficit for about 3 years now. And the reason that price took some inventories that had been left over as Japan and Europe and even the United States shut down their nuclear reactors following Fukushima. Basically, production kept in line. In fact, production grew over the years following Fukushima as Kazakhstan ramped up into the market. And you lost 20 to 30% of your nuclear reactors. So you were definitely in a surplus. And that's when we were out of the uranium space. Inventories piled up, mostly in Japan, and prices collapsed. But by 2019, when we started to get excited about uranium, we made the determination that, in fact, mine supply was now running behind reactor demand, that you were in a deficit, but you had this overhang from all the inventories that had been accumulated. And so just like back in the early 2000s, when you had to determine when the government stockpiles were about to be depleted in uranium, which is what the catalyst for the major price rally of uranium went up 10-fold, 15-fold in the early 2000s. It was the same thing here. You had to do the back of the napkin calculation, and you said, when will these inventories be exhausted? And the answer came out, sometime between 2021 and 2023. You can't be so precise, but you were clearly at the end of this run, this bear run. And so that's when we got excited. And those factors are still very much in force today, because now, when you look at uranium over the next 5 or 6 years, and I should point out, for all the talk of SMRs, which we've visited all the SMR companies, we understand all these technologies, I think, frankly, better than most. And some of them will be the future of nuclear power. It's all a 2030 story. The story for investors today between 2024 and 2030 is going to be one of supply, because demand is fairly well set. We know what's coming online. We know what new reactors are being built. They're fairly long lead time. Demand is quite robust out of places like China, and life extensions here in the West as well for facilities that maybe would have been closed that are now will remain open for several years longer. And the fuel buyers are mostly, I don't want to say price agnostic, but they're not very price sensitive, because once you've built a nuclear reactor, you better fuel it. The cost, what could you pay for nuclear fuel, aka uranium? You could pay $300 a pound for U3O8, no problem. It wouldn't impact your decision to buy that next fuel rod once the reactor has been built. So if it's not going to be demand that eventually ends the bull run, it'll be supply. And so you have to watch very carefully about how much capital comes into the space and how many new projects get sanctioned and what comes online. And the two big ones to watch are Kazakhstan, which has now announced their first disappointment, and I don't think it's their last. And by the way, Kazakhstan talks all the time about bottlenecks and acid shortages, and that's only half the story. The problem is that their new deposits require more acid than their old deposits. And so, yes, it is an acid problem, but it's a geological problem as much as it's a logistical problem. The second one will be, NextGen, which we think is a wonderful project. We do own NextGen as a stock, but I'm not convinced that their project timeline will be able to be as aggressive as they claim it will be, which is, I think, now 2027 they're hoping for. So those are kind of the two big sources of new supply that people are looking for. With those, by the way, we still think the market will be in deficit, but obviously both of those would represent big increases in mine production. But I think both of those are very much at risk. Certainly their timelines are at risk, and those remain two very bullish data points to come out into this market. So I think you want to be involved in uranium. It's had a huge pullback here. Not so much the uranium price, which has had a mild pullback, but the uranium stocks have had a big pullback, and the values in them, which were at X 6 months ago, are now many times at half X today, and represent, I think, very, very attractive valuations.
Yeah, Jesse, this is the last great buying opportunity in this uranium bull market. So I think if investors have missed the first leg, this is your opportunity to get involved again. And the other thing, remember, we are coming to the realization that if you believe that CO2 is causing, global climate change, then this is your only solution. And I think people are beginning to recognize that. As we wrote in our last letter, even Australia, which has the most vehement anti-nuclear movement in the last 30 years embedded in their society, even they are now debating on whether they should build 7 new reactors. So, it's a great story from both the demand side and supply side.
Yeah, and how insane is that one of the greatest uranium mining jurisdictions in the world has a government that's completely anti-nuclear and won't even use that uranium for their own clean energy purposes. So I definitely do see that turning at some point as well. Logic hopefully eventually will prevail. You're also both very bullish on the energy space, and it seems like natural gas in particular has your attention. This is very interesting because almost no one else I talk to about natural gas has taken a bullish stance. You noted in the report that US natural gas production is plummeting and no one is paying attention. So walk us through the setup you're seeing for natural gas. As is tradition, Leigh, I will start with you.
Okay, the what's interesting is you're dead right, Jesse. One of the fascinating things is if you punch out all these Bloomberg stories, and I just got one from S&P Global today, Commodity Insights. They talk about this coming surge in electricity demand, and that seems to be an accepted fact. And we as being big believers in Jevons paradox, that's something that we would believe in big time. And people are beginning to make the conclusion that the only way you're going to meet this surge in electricity demand is through natural gas. In fact, this S&P Global piece right here talks about natural gas will be the big beneficiary. But for some strange reason, people can't make the transition. They're thinking that, how do I play this? What is the best way to play it? The best way to play it is to own the molecule in the ground. And yet, I have not read a report by anyone. All these people say natural electricity consumption is soaring. Natural gas is the natural beneficiary. That's the end of it. No, what the end should be, you have to buy natural gas stocks. Now, I am convinced that in the next several years, that huge bidding wars will break out from various natural gas consumption participants for these assets, which now I would say, given today's gas price, are being given away. And so the best way to play that is by owning natural gas stocks. And for some strange reason, the investment community, as it's not making that conclusion that you want to own the molecule in the ground.
Adam, your thoughts?
Well, I just think that the U.S. natural gas markets today are terribly dislocated. On an energy equivalent basis, you're talking about a molecule that's 90% cheaper than anywhere else on Earth. And there's been good reason for that for a long time, but the supply side is quickly eroding here. And you're seeing US gas supplies off 5%, 5 BCF per day so far this year. And it's just not sustainable to be able to go forward with demand growing, LNG demand growing, AI data center demand growing. It's a bit of a finger in the air what that's going to contribute, but by all measures, it seems to be quite impactful. And, could the shales have met all that demand 5 or 6 years ago? Yeah, they could have. You're talking about numbers like 7 BCF a day between now and 2030 for AI data center demand. You're talking about another, 7 to 15 BCF a day for LNG. Those are levels that in their most robust periods of growth, the shales could have met. However, the shales are not in their most robust periods of growth. They've all rolled over, including the Marcellus, including the Permian. They're off now 5% since December, which is quite sharp. It's a very sharp decline. And frankly, you can't meet any demand growth, and certainly not strong demand growth, with a supply base that is declining. People think that the production is declining because of things like pipeline bottlenecks, or the one that I find funny, they think it's low prices that are causing production to fall, and they use that as an argument for saying it's not a true rollover, and so prices can't rise because of that. You'll never get a rally because production would come back on, but clearly you need higher prices in order to incentivize that production to come back on. But anyway, I think all of that misses the point. This is a geological issue. We have, going back 10 or 15 years, two very, very key examples of shale basins that peaked, plateaued, and rolled over: the Barnett in Texas and the Fayetteville in Arkansas. Both at the time were the absolute epicenter of the shale revolution. The Barnett was the first shale to come online. The Fayetteville joined it shortly thereafter. And those fields, at the time, nobody really knew whether a shale field would follow the same geological principles as a conventional oil or gas field, which is to say a bell-shaped curve, ramps up, peaks, plateaus, rolls over. People wondered, were the shales different? This is artificial stimulation that you're putting in. This is artificial permeability that you're injecting into the rock. It's source rock, so the gas contents are different than in a sandstone. All these different things made people really unsure as to how they would respond. All that was put to bed with the Barnett and the Fayetteville. They followed exactly the same trends as any conventional field did. They rolled over when half their reserves had been produced, like clockwork. This caught so many people off guard, including Exxon, who bought XTO Energy in 2011, about 6 months before the Barnett rolled over. Now, did they know it was going to roll over? No, they didn't. They thought it was going to grow dramatically. How can I say that with certainty? Because the price that they paid for the Barnett would have not made any sense if they didn't expect huge amounts of growth from that basin. They got it dead wrong because they didn't appreciate the geological forces. So now you fast forward 12, 13 years, and nobody learned their lesson in the Barnett and the Fayetteville, except maybe Exxon. I'm sure they're a little, still sting over that. And the reason that nobody learned the lesson back then was that just as the Barnett and the Fayetteville were rolling over, the Marcellus and the Permian were starting to come online. So when you look at total shale gas production in the US, not just in the Barnett and the Fayetteville, but in the whole country, those rollovers were a blip. You had a huge surge of total growth because the Marcellus and the Permian backfilled the rollover in the Barnett and the Fayetteville. But that doesn't mean there weren't lessons to be learned. And obviously, I think inquisitive analysts should say, okay, let's take the experience from the Barnett and the Fayetteville and estimate when that might happen in the Marcellus and the Permian, right? When will the big sources of growth begin to roll over? Yes, I admit that the Barnett rolling over in 2012 wasn't actionable to the gas market, but there was still a huge amount of information to be gleaned from that and to be applied, albeit 10, 15 years later. And that's where we are today with both the Marcellus and the Permian. And what I think is so interesting is that all the way back in 2018, we built these neural networks, these artificial intelligence engines that were, long before ChatGPT, and it's not nearly as sleek, and you can't ask it questions in, English and get back answers. But what it is trained on is it's trained on every single shale oil and shale gas well drilled in the United States, using every completion parameter, every geological subsurface parameter, how much porosity, permeability, thickness, organic content, you name it, it's all in there. And what it's asked to solve for is what is the expected production profile of the well going to be? And it's extremely accurate. And armed with that information, we could take a stab at trying to predict the total recoverable reserves of all these different basins, including the Marcellus and the Permian. And what we concluded was that around 2020, basically everything was about to hit its halfway mark. 2025 is when we thought the Permian would do it. 2019 was when we thought the Bakken would do it. And everything that we've predicted so far has come out. The Eagle Ford peaked in 15 and rolled over. The Bakken peaked in 2020 and rolled over, has not been able to regain its pre-COVID highs. That's consistent with our analysis. And we made the prediction that 2024 would be the year that the Marcellus began to roll over. And originally we had thought 2025 for the Permian, and we ended up refining the model and pulling it forward a few months to also be 2024. So when we see those things happening today, it doesn't mean that it's 100% the driver. However, our models tell us that that's exactly what we should expect to see. And now we're beginning to see it. So all these people that are out there trying to make other explanations for things like pipeline takeaway capacity and things of that nature, it's not that that can't be true. I just don't think in this case, looking at the geology and having been able to make a before the fact prediction that this would happen this year, and now we're seeing it very, very sharp, I think that gives us a lot of confidence that our models are correct. And I think there's an analogy here to the oil shales. Following COVID, prices collapsed, everyone shut in production, they stopped drilling. There was a huge pervasive bearish view that as soon as oil hit $40 again, the shale guys would really get going and production would surge. Then it was 50, then it was 60, 70. It got up to $120 in the price spike when Russia invaded Ukraine, and we never saw the Bakken or the Eagle Ford make new all-time highs. The Permian did, which we always expected it would, but that growth started to slow and slow and slow and slow, and now it's actually down for the last 6 months. So I don't think this is a price issue. I think it's a geological issue. And I think that just like in the oil market, everyone's expecting price to be a signal or pipelines to be a signal that you put the pedal to the metal and off you go. And I think the big surprise to the market is that you're going to press down on that accelerator and there's not going to be a lot behind it. In fact, I think production is just going to continue to move lower. And that's extremely bullish.
The only thing I would add, Jesse, to Adam's talk is that the Haynesville also falls into the other third big gas field that has reached its halfway point of producing its ultimate recoverable reserves, and that's in the process of rolling over as well. So you have the three big gas fields. You have the Marcellus, Permian, and Haynesville all rolling over.
Well, I want to end on discussing a commodity that was not covered in your recent market commentary, and that is silver. I've spoken to a lot of people who are very bullish on silver right now, including the mining equities, as they see increasing industrial demand, retail demand from the east, eventually moving to the west, and bottom of the basement sentiment. I mean, I don't know if there's a sector right now outside of silver that's as hated by the retail audience, anyways. What are your thoughts on silver right now? Do you think it presents an opportunity? And Leigh, once again, start with you.
Yes, in when this bull market in gold is over, and this bull market in gold, in the end, I think is going to get completely out of hand. It's going to rival what we saw in the 1970s, which of course is completely out of people's institutional memory. They don't remember what the 1970s were. I do remember it. I was not on Wall Street, but I was about to enter my Wall Street career. Um, and the thing is that silver will be a good investment. However, if you want it, I have an observation to make about the silver market, which it's I believe it's a true observation, and I think that most people don't quite understand it, but it is true. Studying going all the way back to the early 70s when gold became freely traded, um, silver will lag every gold bull market. And I think that's where the frustration comes from. Now, why this happens, I don't know. It's an observation. Back when the great bull market started in 71, when Nixon took the US off the Bretton Woods gold exchange standard, and gold ran from 35, $40 an ounce up to about 160. Silver lagged the entire way, except for the final 3 or 4 months of the bull market. And then it caught up and then some. In the late 1970s, when the gold bull market was really rolling, silver lagged again. And then when the Hunt brothers emerged trying to corner the silver market in the late 1979, silver then took off and caught up all and then outperformed, except only in the last really 8 months of the bull market. Same thing in the 2000s bull market. It was 2011, 2000. Silver lagged and then caught up in the end. And between 2015 and 2020, again, silver lags the whole way, catches up at a huge furious bull market, and that's it. In fact, I should point out, after every one of those huge catch-up rallies, and they're about the same percentage, about 150 to 175% move in silver prices need to catch up to gold. That's the end of either the gold bull market, or it means that a big corrective phase is happening, which is exactly what happened after 2020. What is silver doing again today? Silver is lagging. Silver is only barely made a new an all-time high versus this 2021 squeeze by the Reddit crowd, and it's basically slightly underneath that, whereas gold is now 15% higher. My gut feel is that gold will lead and silver will lag, just like it has every time. Now, the opportunity comes in the end of the bull market after silver lags. It does. It will stage another furious catch-up rally. So I think people's frustration with silver today and say, why isn't it performing as well as gold? Why isn't it getting the same type of movements? Is because this is what silver always does. Why this does, I have no idea. But it's just an observation of mine going back, and it seems to be playing out again in this gold bull market. So I think gold will be the place to be, except for that furious catch-up rally, which is still years away.
And Adam, your thoughts on the silver space?
No, I think Lee summed it up perfectly. I think that observation is absolutely fascinating and something that, frankly, when Lee first told it to me, I never had heard it anywhere else. And looking through the data, I mean, is spot on. And so I think this pervasive view that for gold to be in a robust bull market, you need to have silver leading and in a bull market as well is just not true. By the end, everyone remembers that period of the silver outperformance. However, it's a little lumpier in the middle.
Well, gentlemen, this has been a fantastic conversation, as I expected it would be. Thank you both so much for coming on. Before I do let you go, of course, tell us about Goehring and Rosenzweig, what you do there, where people can find the research reports as well, because as I mentioned at the top of the show, they're some of the best out there.
Yeah, Jesse, when Adam and I founded Goehring and Rosenzweig back in the first quarter, January 1st of 2016, I told Adam that, we wanted to be known as the people that do the best research on global commodity markets. And of course, that's something we strive to do day in and day out in what we do. But ironically, a lot of people know us for our research, and it's what we're best known for. But we really, our number one business line is we're money managers, and we've been managing. I've been managing money much of the time with added assistance, going all the way back, almost 35 years in the natural resource space. So it's what we really do. So you can follow what we are thinking by our research, because we put it all in the public domain, and that's what we're really well known for. But it's our money management services that is our main line of business. And I can't talk about performance on here because of all the FINRA regulations and things like that, but we can certainly pass on to you. We have a phenomenal long-term record. We're contrarian investors. We use the best time to find value in any commodity market is when commodity prices are depressed, no one has an interest in it, and that's where the real value is. And that's we've got very, very good at. That's when we actually make our investments right at the bottom when no one else is interested. It's wound up with tremendous long-term performance.
Fantastic. Well, I'll put a link in the description below to the Goehring and Rozencwajg website so people can check out both your fund managing services as well as your fantastic research. Thank you once again, gentlemen, for coming on the show. It's been a blast.
Okay, very good, Jesse. Thank you for having us on again.
Thank you.